All right, so let's get right into it. For as long as most of us can remember, HDFC Bank has been this rock-solid giant, right? The gold standard, the one stock you could always count on. But lately, things have gotten, well, chaotic, and it's left pretty much everyone asking the same question. What in the world is going on with HDFC Bank?
It really all kicked off with this one single sentence. On March 18th, the bank's chairman, Atanu Chakrabarty, suddenly resigned, and he didn't just quietly walk away. In his official letter, he dropped this bombshell that something at the bank clashed with his personal values and ethics. Think about that. No details, no specifics, just this incredibly vague but very worrying phrase that basically lit a match under the entire market. And boy, was the reaction swift and brutal. The very next day, the stock took a nosedive, plunging 8.7% in just one session. Now, this wasn't just a bad day. It was the bank's worst crash in years. And because HDFC is such a heavyweight in the Nifty 50, it's like an anchor. When it sinks, it drags everyone else down with it. And that's exactly what happened. So to really understand this whole mess, we have to start right there with that shocking resignation. It was the spark that lit the fuse. It created this information black hole. And if there's one thing the market absolutely cannot stand, it's uncertainty. But this is where the story gets even weirder. In his formal written resignation, he uses the phrase values and ethics. I mean, that sounds serious, right? It makes you think something shady or improper was going on. But then he goes on TV and walks it back, calling it just ideological differences. Wait, what? Which one is it? A major ethical crisis or just a simple disagreement on strategy? The mixed messages just fueled the fire, and nobody knew what to believe. And you can just see how fast things went downhill. The resignation hits on the 18th, the market panics on the 19th, and by the end of the month, the stock hits a new low for the year. And get this, a staggering 1 lakh crore rupees of investor wealth just vanished, wiped out. But here's the key. The chairman leaving, that wasn't the real disease. It was just the first, very public symptom of some much deeper problems. So let's start peeling back the layers of this onion, shall we? And the first thing we find is a pretty nasty scandal involving the alleged mis-selling of some seriously risky financial products. The product at the center of it all is something called AT1 bonds. Now stick with me here. Think of it like this. A normal, safe bond is like a loan to an airline. They have to pay you back. An AT1 bond, though, is a whole different beast. You get a much, much higher interest rate, which sounds great, but there's a huge catch. The airline might never pay you back your original money, and if it gets into big trouble, poof, your entire investment can disappear. You're basically at the very back of the line, treated like a shareholder, not a lender. High risk, high reward, in theory. And this isn't some textbook exercise. This happened to real people. Take the story of an NRI we'll call Rajesh. An HDFC manager allegedly pitches him these safe bonds from a huge bank, Credit Suisse, promising an incredible 13% return. So Rajesh thinks, wow, what a deal, and invests his entire life savings, 1 crore rupees. Fast forward 2 years, Credit Suisse implodes. Swiss regulators just decide to write off these bonds completely. And just like that, Rajesh's 1 crore becomes 0. Overnight. And apparently he wasn't the only one this happened to. So the bond scandal is bad, right? A huge hit to their reputation. But believe it or not, it might just be a symptom of a much bigger, more fundamental problem. And to find it, we have to go back to that massive, celebrated merger with its parent company, HDFC Limited, back in 2023.
Okay, quick banking 101, I promise it'll be quick. A bank makes money by taking in deposits and lending that money out at a higher rate. Simple. But here's the key. Not all deposits are created equal. Money in current and savings accounts, that's called CASA, is super cheap money for the bank. But fixed deposits, FDs, are expensive because the bank has to pay out much higher interest. So the magic formula for a super profitable bank is to get as much of that cheap CASA money as you can. And HDFC Bank, they were the absolute kings of this. Before the merger, their net interest margin, which is just a fancy way of saying their core profitability, was a super healthy 4.1%. I mean, this was their secret sauce. This was the engine that powered the whole machine. And then the merger happens. And look at that. That healthy margin gets squeezed all the way down to about 3%. Now, that might not sound like a huge drop, but for a bank the size of HDFC, that is a massive blow to their profitability. So what on earth happened?
Well, it really boils down to 3 things. 1, the bank suddenly inherited a gigantic pile of low-interest home loans from HDFC Limited, which dragged down their overall earnings. 2, they didn't get enough of those cheap CASA deposits to fund all these new loans, so they had to go out and raise money the expensive way by offering high-interest FDs. And 3, a sneaky hidden cost that almost nobody was talking about.
Let's dig into those numbers just a little bit, because this is where you can really see the full extent of the pressure on the bank's balance sheet. It becomes crystal clear.
So in India, the Reserve Bank has these rules called CRR and SLR. All it means is that for every 100 rupees a bank takes in, it has to lock away about 21 rupees. That money can't be lent out. It's a safety buffer, just sitting there earning next to nothing.
Now, here's the crucial plot twist. HDFC LT, the housing finance company, wasn't a bank. It was an NBFC. And NBFCs don't have to follow those rules. They could lend out pretty much every rupee they raised. But the second it merged and became part of HDFC Bank, bam! That entire massive operation now has to play by the much stricter and much more expensive banking rules.
And the impact of that one change is just mind-boggling. An estimated 1.3 lakh crores of capital is now essentially frozen, sitting idle and earning almost nothing, all because of these new regulations. That's a colossal amount of money that could have been out there making profits, but now it's just stuck on the sidelines.
You can also see this pressure in the bank's loan-to-deposit ratio. Before the merger, it was a totally reasonable 87%, but right after it shot up to a wild 110%, meaning they'd lent out way more money than they had in deposits. Now, they've worked to bring it down, but as you can see, it is still way above the RBI's recommended comfort zone. It's a clear signal of a major imbalance.
So when you put all these pieces together, the reputational scandal, the immense financial strain, the unbalanced books, you finally get to the ultimate and most dangerous consequence of it all.
It truly is a perfect storm. You have the AT1 bond scandal hammering their reputation. You have the merger creating this deep financial strain by crushing their profit margins. And underneath it all, you have this risky imbalance, with loans growing much, much faster than the cheap deposits they need to fund them.
And all of this culminates in the erosion of the single most important asset any bank has: trust. For any other business, a trust problem is a challenge, something you manage. But for a bank, it's something far more serious. For a bank, a trust problem is an existential crisis. Which brings us to the final critical question. The numbers on a balance sheet, those can be fixed. The profit margins, they can be restored over time. But trust, once it's lost, is incredibly hard to rebuild. For a bank that was once considered India's absolute most trusted financial institution, the biggest challenge ahead isn't on a spreadsheet. It's in the minds of its investors and its customers. Can HDFC Bank win that trust back?